Welcome to Speidel's Federal Tax Minute. I'm your host, Catherine Sedan. This week, we're covering a potential double taxation issue for trusts that the Joint Committee on Taxation just addressed in its Bluebook. To stay up to date with federal tax law news, subscribe to Speidel's Federal Tax Letter. You can get details on this monthly subscription and download a sample issue at speidel.com under Publications. We've received many questions from tax professionals about a potential double taxation problem for trusts that's buried in the One Big Beautiful Bill Act. Tax professionals with clients that have non-grantor trusts should pay attention to this issue. OBBBA reinstated the overall limitation on itemized deductions for taxpayers in the highest marginal income tax bracket. Prior to 2018, the code contained a similar limitation that explicitly excluded trusts and estates. The new itemized deduction limitation under OBBBA does not exclude trusts and estates, which is where the problem starts. Under Subchapter J of the Code, trusts act as conduits. When a trust distributes income to its beneficiaries, it takes the income distribution deduction and the beneficiary picks up that income on their own return. This is the mechanism that prevents the same income from being taxed twice. But here's the double tax trap. If the new IRC Section 68 limitation applies to these distribution deductions, the trust loses part of its deduction, pays the tax on the disallowed portion, and the beneficiary still reports the full distribution in income, so the same dollars get taxed at both levels. The Joint Committee on Taxation addressed this issue in its Bluebook, which is the official explanatory guide to the OBBBA. The JCT's position is that because IRC Section 641 subsection B says trust taxable income is generally computed the same as an individual taxpayer, and because the distribution deductions are not specifically carved out, they fall within the definition of itemized deductions and therefore are subject to the new limitation. Major professional organizations, including the AICPA, the American College of Trust and Estate Counsel, and the New York State Bar Association, have all pushed back on this. They argue the JCT's interpretation ignores the broader structure of the code. This has several implications for your clients. First, be aware that trusts hit the 37% bracket at a very compressed threshold, just over $16,000 of taxable income, so this limitation can kick in even on modest trust income. Second, if your clients have simple trusts, which are required to distribute all income, they face a particularly unfair result. Even if every dollar goes to the beneficiary, the trust could still owe tax on a portion of that income, and the beneficiary still owes tax on the full amount. Third, for trusts with charitable beneficiaries or income in respect of a decedent, the consequences may be even more severe, creating what some practitioners are calling an algebraic loop, where the tax caused by the limitation keeps recalculating the limitation itself. And fourth, trustees may need to set aside cash to pay this additional tax, either by selling assets or reducing distributions to beneficiaries. The Bluebook is an interpretation, not law. The Treasury and the IRS still have an opportunity to issue guidance clarifying that distribution deductions are not subject to the new limitation. But as of right now, the rules are unclear. For clients with non-grantor trusts, especially those with mandatory distribution requirements or charitable provisions, this is a conversation that needs to happen right now. Speidel's Summer Tax Webinar brings together the topics our customers consistently ask for, so you get the information that's most relevant to your practice. This year, we're covering using AI in your tax practice, S-corporation and partnership basis, stock incentives, and estate planning. For details and to register, go to speidel.com and click Webinars. That's all for this week. Join us next time for another episode of Speidel's Federal Tax Minute.